We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gary Savage, retired entrepreneur, stock and commodity trader, and founder of smartmoneytrackerpremium.com. How are you today, Gary?
I'm doing good, Tom. Thanks for having me on.
Well, it's great that we were able to kind of re-record. We had some audio technicalities that it didn't sound great. So Gary was gracious enough to join us again, and we're going to go back over the same charts just to basically re-record and make the video better for everybody here. So thanks for joining us again, Gary. So since the FOMC meeting, we've seen a decline in the S&P, and you've been saying that we are likely to see more of an intermediate decline here. So if they're able to keep propping the market up, why even get this intermediate low?
So after today, there was some question yesterday when we did this recording that maybe we had already completed that daily cycle low on Friday, because we had a pretty big bounce yesterday. And if we have, then it pushes that larger intermediate decline out another complete daily cycle. And today the S&P has rallied back above the 10-day moving average. So I think the odds are pretty good that we did complete that daily cycle low. And now we're going to have to wait another 20 to 40 days before the next daily cycle low, which should be the intermediate cycle low, comes in. Doesn't mean that we're going to get the top immediately. Usually the market will rally into the 4th of July. So I don't really expect a top before that, but after that, things might get a little dicey.
Mm-hmm. So if we get a correction in the markets, could we see the Fed back away from the interest rate hikes that they were thinking about doing?
Actually, I think the Fed's talking today, and they're already kind of starting to walk things back. You notice the dollar's weaker today. So they may have already decided they made a small mistake there.
It's interesting that we haven't seen gold really react to that either yet.
Yeah, they're going to try and keep gold suppressed. And as we discussed yesterday, I'm pretty sure gold started an intermediate decline. We're due for some kind of bounce here, but my expectation right now is that it's not going to be a very strong bounce, and it'll probably roll over and make a lower low. There's a few things I need to see as it progresses that might change my mind and convince me that maybe we're ready to make a larger degree bottom, but that's something that'll take a little while to play out.
Mm-hmm. So how far stretched above the 200-day moving average or even the 200-week moving averages? I know that's an average that you like to look at. How far stretched above those are we in the S&P right now?
So let me put up a long-term chart here, and we can show this. This is one of the things that I use a lot is regression. And when markets get extremely stretched above the long-term means, then that's when I become nervous. So give me a second here. Let me find this chart. All right, here we go. So, and this is what makes me think we're probably in the middle stages of a bubble. So the crash last March, this was what I call the slingshot down. It kind of loads, sets the stage for the rocket launch. And almost all bubbles start off this way. They have a counter trend move that gets everybody on the wrong side of the boat. And that's what this was last March, got everybody on the wrong side of the boat. And then central banks start printing endless amounts of QE, and you get this very aggressive V-shaped recovery that recovers that entire crash very quickly. The same thing happened in '98, right before we started the tech bubble. I think, and actually you can see this a little better in the Nasdaq. Let me try and pull up that chart. Because I think the bubble is going to be in the tech sector again. Mm-hmm. So what I think is happening is I think this right here is a midpoint consolidation. And once we're done with this, I think then there's a good chance we can get a move of the same magnitude as this first move from the bottom to where we started this consolidation. And that's roughly 8,000 points. Not sure that we're getting ready to break out of this today, even though we're making marginal highs. Breakouts that occur late in an intermediate cycle tend to not produce sustained moves. So I doubt that we're ready for a sustained breakout and in that big run into that final melt up top just yet. But I think we're getting close.
So as we're talking about that V-shaped recovery, Gary, is the rate of climb or the angle of that chart since last March crash signaling how overheated this market is as well?
It is, and you can. I'll put the chart back up again, but you can see exactly how far. You can see the change actually. So during the middle part of the bull market, price never got stretched terribly far above the long-term moving average. When it does, you tend to have a regression event, and the further it stretches in one direction, the more likely it is to overreact on the other side. We got a little stretched back in 2018. We had a pretty big move down, and again at the end of 2019, right before the crash, and then we get this big move back down to the moving average. But now you can see that we've had a big character change from the prior 10 years, and that makes me think that we're in the middle part of the bubble phase of the bull market. But we haven't had anything that I would qualify as a final melt up parabolic bubble phase just yet.
So as in that same vein, Gary, that we're talking about that melt up phase, we've really seen this two legs up in the Nasdaq since that March low that you're talking about. Are we likely to get three total? And is this a longer term kind of ABC move that you're looking for?
Yeah, I do think we're going to get another leg up. There's going to be volatility during that leg. I guarantee there will. There was during the bubble phase in 99 and 2000. We had a couple of corrections right in the middle of that final bubble phase where the Nasdaq corrected. I believe it was 12% and 14%. And it did it very quickly in like 6 to 8 days. I'm sure we're going to have that kind of volatility during this final bubble phase as well. So, to answer your question, yes, I think we have another leg up. And yes, I think it's going to be pretty volatile and pretty hard to hold on to as it occurring in real time.
And if we look at the kind of timeline that this last leg up has happened over about the last 15 months, you were saying that the next timeline for this next leg up is going to be more compressed than that, but almost a similar move up proportionately that we just saw, right?
Yeah. So when you get that final melt up phase, it can occur pretty quickly. 2 to 3 months. So, it took almost a year to do this 8,000 points. It could do the next 8,000 in 3 to 4 months. That's kind of what happens during those parabolic bubble phases. And that's another clue when you get that kind of extreme move in that short a period of time. That's the bell ringing that you're in a bubble. And at some point you got to control greed and say, hey, I made enough money. I don't want to get caught in the crash when it comes.
Mm-hmm. And exactly in that vein, Gary, how do you think about, let's say, taking profits in a bubble scenario like that instead of getting caught in the crash? We're already looking at that chart. It looks so far stretched from the moving average as it shows right there. So do you have any way of trying to capitalize on that next move up?
So I have never figured out any kind of consistent way to call the top of a bubble. So what I tell people is just at some point you have to control greed, and you just have to say, hey, I've made enough money. I'm going to cash out here, and I'm going to go look for something else that isn't extended like this, someplace that with a lot less risk. And I'm going to take my profits here and put them over there. And like right now, what I've been telling people, and again, I don't think we have the final bubble phase yet, but like specifically for Bitcoin, I think was in a bubble. I think the bubble has popped. And I was trying to convince people a couple of months ago to to be happy with those gains. Bitcoin had gone up 200% in like 4 months. If you can't take profits after 200% in 4 months, you got problems. But I was trying to get people to take profits on their Bitcoin, at least, some profits, if not most profits, and maybe put it into silver or something like that has more potential, or just in the commodity markets in general, because I think they've started, or they did start back in March, a long-term secular bull market.
So Gary, as we're talking about that regression to the mean, walk us through the Bitcoin chart and how you were really looking at how overstretched it was, and why you were trying to warn people to take some of their profits out of Bitcoin at that point.
So this is a really good example of regression. And I call it the rubber band theory. The further the rubber band gets stretched to one side, the more violent and extreme or proportional the move tends to be back to the other side. And so at this point right here during this preliminary peak, Bitcoin was stretched 240% above the 200-day moving average. Now, for a lot of investors, they become very overconfident. They think that there's no risk in this asset, and it's going up forever. I'm hearing calls for $100,000 Bitcoin or $1 million Bitcoin. And for me, it's the exact opposite. If I see something that's 240% above the 200-day moving average, I am very, very nervous. So I'm trimming positions. I'm not buying positions at this point. And then this is kind of what locks people in, and this is why almost nobody ever makes any money off of a bubble, is every time you get one of these dips and they get bought, it just cements in traders' brains that there is no risk. And so they become more and more confident that their target is going to get hit. And as this moves up, the targets keep going higher. So, maybe on the original breakout at 20,000, your target maybe was 30 or 40,000. Well, when it gets to 40,000, now your target becomes 60 or 70,000. And once it gets to 60 or 70,000, just like, I was seeing, people are calling for 100,000. So there is actually, because of human nature, there's no target where you actually sell, because every time your target hits, you just envision a higher target. And every time a dip gets recovered, that just cements in your brain even more firmly that, hey, there is no risk, and every dip is a buying opportunity. And that guarantees that you get caught when the bubble pops. And so this was the warning sign. On the way up, it was making higher highs and higher lows. So each one of these were occurring at higher levels. That's where this changed. We made a lower low. We broke below that. That was the warning bell going off that something was wrong now. And then when we get this bounce, I'm seeing lots of people they want to buy very quickly, or maybe people that miss this, they're very anxious about missing the next move because they're anticipating another one of these and they don't want to miss it. So they are very quick to buy this move. And I tried to warn people that, even if the bubble hasn't popped, intermediate degree declines almost always unfold as an ABC move. So this would be the B wave up with the expectations there's going to be another C wave down that makes a lower low. But because people had become convinced that Bitcoin was going to whatever target they had, they were in a big rush to buy, and they're buying too quickly. And then the C wave down is typically when the bubble pops, this is the really destructive wave down, and it was. So at this bottom, it was I think we'd lost about 50% off of from the highs. So anybody that bought up here is deeply underwater. And then again, at this top, even though momentum had slowed a little bit and the moving average had caught up some, it was still 150% above the 200-day moving average. So the expectation is that this was a bubble. It is popping. It is the air's coming out. And because this was stretched so far above this long-term mean, it's probably going to go a proportional distance below it before this stops. So I'm still seeing people anxious to get on board. And as long as there's people still anxious to get on board, it's probably not done going down. So most of the time, these bubbles will retrace all of the parabolic phase, which you can make a case that it started here at 20,000, or maybe you can make a case that it started, back down here at 10 or 12,000, whatever this is. But I think the odds are really high it's going to retrace back to 20,000, and it may go much lower. And then again, people are going to want to try and pick the bottom, and it'll be too quick. It takes time for this to, the bear market to work off those excesses. And when a bubble pops, it can take multiple years. So a lot of times, even if you were to get the exact bottom of the bear market, it's still going to be dead money because the market just kind of chops around going sideways for many months or even several years before it starts getting the upward momentum again. So I kind of think the Bitcoin or crypto market is probably dead for a while.
So Gary, can we switch to the gold chart and see what that looks like comparatively with that long-term moving average? And as we've broken that $1,800 support level, how important is momentum when analyzing these moves?
So it seems pretty obvious to me that we've when the bears broke that 1,800 level, that was an important. It was an important resistance level right here. I think the bullion banks were trying to stop this rally. They were unsuccessful, and then we get another nice leg up. But the bears were able to break this again on the way down. So now this is going to act as resistance again. And I'm pretty sure we're in an intermediate decline, and the same principle applies. Most intermediate declines, doesn't matter the asset, usually unfold as an ABC move. So we're due any time now for a bounce, but it may just be a bounce that comes back up, tags this 200-day moving average, and then has to come down and make a lower low. So it's probably going to be a few more weeks before the gold market is ready for another sustained intermediate rally where we're making higher highs and higher lows again. Right now, I think we've probably transitioned into the declining phase of the intermediate cycle, and we're probably going to make lower highs and lower lows for a little bit. So when we get this bounce, I doubt it's going to come up and break this top. It's probably going to top prior to that and then roll over and make another lower low.
So as we think about, let's say, gold in the bigger picture, what has a bigger effect on the gold price? Is it the dollar gaining relative strength, or is it possible that the bullion banks are trying to close their short positions right now ahead of the end of June?
I think it's both. I think the banks, they have a much larger position in silver. They need to get out of those positions. So I think it's both. I think it's also governments. Commodities are kind of the Achilles heel for printing money. They want inflation, but they want it where they want it to go. They want it in stock market and real estate. They don't want the inflation to leak into the commodity markets. You can, either try and control all of the commodity markets, which is pretty much impossible, or you can try and control the canary in the coal mine, which is gold. If you can keep gold suppressed, it does have, or it did have, a tendency to keep the other commodity markets suppressed. It's kind of quit working since last August. They've kept gold contained pretty well. And silver, they've kept it locked in a sideways churning consolidation, but it hasn't stopped traders from pushing the price of pretty much all other commodities much higher, especially oil, which is oil is what causes recessions. When the price of oil goes too high too quick, then that's what causes a recession. And it's not really having any effect on those things. Now, I will say this, the commodity market or this bull leg in the commodity market is pretty mature. We're due any time now for some kind of an intermediate decline, but it'll just be temporary. And then I think the bull market still has, 5, 7, 8 years to go yet. I think it just started back in last March.
So there's some debate in the metals community whether gold and silver are manipulated. So how do you take that into consideration when trying to chart a manipulated market? Is it still possible to do, Gary?
It's very difficult. You have to try and anticipate when manipulation. They're not going to ring a bell for you. They're not going to send you an email and say it's coming. So I have some success at it and some not so successful. This move in here in particular, I was because of the length of this daily cycle is really long. It's really mature and it's getting really stretched. My assumption was that the FOMC meeting would be more dovish and it would trigger a bottom in the euro, top in the dollar, and we'd get another leg up in gold, a nice momentum move that would maybe take us back up to the highs from last year. and it caught me off guard. I wasn't expecting the exact opposite. And so instead of a termination of this really long daily cycle, it extended it even further, and then it kind of gave the bullion banks probably an opening here to smash gold and silver even more, and maybe get out a few more of those shorts on especially silver. But I did check out the COTs from last week, and they did cover a few of those shorts in gold, and that was prior to this attack. So they were covering shorts back here on Tuesday. So I'm interested to see what the COT is going to be this week, because it's going to be data taken from today. And maybe we may have a really bullish COT next Friday when the data comes out.
So, Gary, can we have a look at the silver chart and see what kind of relative strength there is building in silver versus gold? You have some interesting ways of looking at the silver chart here. So what are we seeing there?
So silver, this is very interesting. It's been much stronger than gold since that top in August. Gold has stair-stepped down. This was an intermediate cycle low in gold, and then gold made the top of that intermediate cycle did not make a higher high, whereas in silver it did, and then gold made a lower low, whereas the intermediate cycle low here in silver did not make a lower low. So silver, very unusual. Silver is usually weaker than gold, but in this particular instance, silver has been much stronger. Maybe we're starting to get some shortages in silver. I think a lot of people are starting to buy physical silver. I've recommended for my subscribers to buy and store physical silver. So, very, very unusual. I don't usually see this where silver is stronger than gold, but it is. But it too is going to be in an intermediate decline if gold is. So, again, I expect a bounce, probably one that doesn't make a higher high, and then we make a lower low. So maybe we come back down, into the lower range of this consolidation box that it's been in.
So something that you had said the other day that you were saying that silver is starting to get harder and harder to manipulate. So why do you feel that is, Gary?
Yeah, that's what I think maybe there are some shortages starting to develop in the silver market. You're seeing the premiums were not contracts that they can create at will. Thousands and thousands of them to keep the price suppressed. But the actual price of silver, when you go to buy physical silver, the premiums are huge. So that would suggest to me that we're getting a little tight in the silver market. So it's becoming, I think, a little bit more dangerous for the banks to keep attacking silver, in that they could get caught in a short squeeze, and they may have to actually go in and buy silver, physical silver for traders that want to take delivery of their silver in these futures markets if they want to stand for delivery.
So once we see this, let's say this downspout clear, what are your next targets for silver?
So it all depends on when it breaks out of this sideways consolidation it's been in. The top is about $30. So the rule is the longer the base, the higher in space. So this base has been going on since last August. So it's a really long base. This can power a really big move once a breakout occurs. My thinking is that this is a long enough base that when it breaks out, it's going to go to $40. There's just no doubt in my mind that once we break out of this base, we're going to hit 40. And if we hit 40, I think that magic number 50 is going to start pulling like a magnet. So my opinion is that a breakout from this is probably going to take silver to 50 before the next intermediate correction.
Excellent. So as a technical chart analyst, Gary, do you take into consideration the daily news events when you're looking at these charts, or does it just add unnecessary noise?
So, news can have a temporary effect on markets, but usually after a day or two, the market kind of forgets that as being old news, and they start looking forward to something else, and the market just kind of tends to go back to doing what it was doing. And that's kind of why I like cycles. When a cycle is due to bottom, then somehow or another, the news just always seems to pop up to, give the media something to blame the bottom on, so to speak. So, I don't know what's going to be the bottom for gold. Like I said, we've probably got another daily cycle, so I'm going to guess we won't get a final intermediate bottom till maybe sometime late in July or early August. But there'll be some reason will magically pop up for why gold is bottomed.
So, Gary, your third common sense trading rule is to manage risk, and the rest will take care of itself. So, how do you think about going about managing risk in your portfolio?
So, for us, this is where cycles come into play, and I'll show you this on the S&P chart right here. So, the correct place to put a stop is at below a daily cycle low. If a daily cycle low gets broken, it means the cycle is left translating and you want to get out of the way. So yesterday, when we talked, we had this powerful rally and there was some question as to whether or not that might be, that this might end up being a final daily cycle low. We got some follow through today and where the S&P is back above the 10-day moving average. So this morning, when we got that follow through, I may have jumped the gun a little bit, but since we're closed now, we know that I didn't, and we are closing above the 10-day moving average. So I told people, I said, you can go ahead and take positions. I would not get leverage right here because the intermediate cycle is getting pretty mature, but I think you can take unleveraged positions. And my preference is going to be tech, the QQQ or semis. Those are the leading sectors. That's probably where the bubble is going to occur when it does occur. But you could take positions unleveraged in like QQQ and SOXX. And then you put your stop and you use the S&P as your trigger for the stop because the S&P is the cyclical driver for stocks. But you put your stop right here at about 41.64. If the S&P comes back down and breaks below 41.64, it's the bell ringing that this daily cycle has rolled over and left translated, and that we're now in the declining phase of that intermediate cycle like we are in gold. And so at that point, you want to get out and you want to wait for the intermediate cycle to bottom. So this is how we're controlling risk in our stock positions right now. We got a stop right here. And if that gets hit, you're back on the sidelines.
And you were saying one of the other ways that you control risk in your portfolio is to really kind of split it up into three sections: energy, metals, and equities. So how does that work as well, Gary?
So that's been my recommendation for people that are subscribing to my newsletter is split. Don't get too heavy in any one sector. I like energy and I like metals because I think we started a secular commodity bull market, but I don't think that the bull market in stocks is over yet. So I think you want to have some there. So just go 1/3, 1/3, 1/3 in each one. And almost always something's going to be working. And when we get like in metals, where we're probably in an intermediate decline, then you definitely want to be getting out of leverage. You want to be getting either into unleveraged, or you want to be trimming your unleveraged positions, or once we get confirmation that we're in an intermediate decline, then you want to just get on the sidelines and wait for the intermediate cycle low. But I think if traders don't get too heavily leveraged, putting all their eggs in one basket, then something's always going to be working. Either stocks or energy, those tend to work together, and sometimes everything will go up together. But for the most part, it seems like when stocks and energy are working, gold is usually lagging a little bit, or it's in an intermediate decline, kind of like it is right now. And then when the other ones are rolling over into an intermediate decline, often then gold is outperforming. So I think that's a really good way to, especially if you've got a retirement account, and it's more important to you not to lose a lot of money than to make a lot of money, then I think that's a pretty good mix.
So do you have any set rules in place around how much cash you like to hold in your portfolio, or do you typically adjust that as you watch the market?
So I adjust it. I don't ever suggest anybody go on margin. There are times where I will suggest maybe people take, if they want to take a little bit of leverage, and I always qualify this in, if you're going to take leverage, like especially in options, don't bet more than you are willing to lose, because the unexpected can always happen. And it happened to us in metals just recently. I was expecting a bottom and then a strong momentum move to polish off this intermediate advance, and the exact opposite occurred. So if you're not betting more than you can afford to lose, then you're okay. If you're getting over leveraged, then you're in trouble when something unexpected happens.
So if we look at the commodities complex in general, Gary, say the CRB index, have we missed the lows, or are we just beginning this new bull era for commodities? You were kind of mentioning that earlier, that we're likely due for a bit more of a correction in the commodities here, a mid-cycle correction. So how do you see that playing out?
So let me pull up the see if I can find that commodity chart. That's not it. There it is. Okay. So this was the top of the last secular bull market in commodities, when oil went to $147. And then we started. That was in
2008, correct?
I'm sorry?
That was in 2008, correct?
That was summer of 2008. And then we started a secular bear market. And so you can see each one of these are 3-year cycles. So 3-year cycle low here, 3-year cycle low here, one here, and you can see how each top came in at a lower level. We didn't make any higher highs in any of these longer 3-year cycles, but that has now changed, and you can see that the CRB has made, at least at this point anyway, a marginally higher high. So we're starting to reverse this pattern of lower lows and lower highs. And now we're starting to make higher highs. And then if you just think of it logically, at that bottom in March last year, oil was, I think, briefly minus $50. If that's not the bottom of a secular bear market, I don't know what is.
So you were also mentioning that the price of oil and that spike that we see in 2008 was kind of due to the housing crisis kind of melting down. So why did oil behave like that, Gary?
So this is a mistake by government planners and central banks. When the housing market started to implode and the stock market topped, the response was to cut rates and print more money. If you remember, they sent out the stimulus checks. So you can print all the money you want. It's not going to make a bubble go back up, not until it's finished going down. So it wasn't going to rescue the housing market, and it wasn't going to rescue the stock market, which had topped. So all of that extra liquidity had to find someplace else to land. And the one thing that was continuing to go up was commodities. So traders are going to put their money where they're being rewarded, where price is going up, instead of fighting a bear market or a collapsing bubble. So all they managed to do by printing all that money and sending people stimulus checks was to spike the price of commodities. And then anytime the price of oil rallies 100% or more in a short period of time, I use a year, it always causes a recession. And so the housing bubble popping definitely weakened the economy a little bit, but it was the mistake by central banks and government planners by printing too much money and causing this inflation that really exacerbated and started the recession in earnest. And it's what made it so bad.
So, Gary, when we think about trying to, let's say, accommodate or position ourselves to not get killed by the inflation that we see happening right now, do you look at taking positions in gold miners? And if so, how do you go about evaluating which companies that you want to take these positions in?
Well, for me, I'm not one of those guys that trades individual stocks. I don't try and analyze individual stocks. You can pick the best company, and for whatever reason, the market may not reward it anyway. So I just stick with ETFs. So GDX, GDXJ, SIL, or you can just invest in the metal. You can buy physical silver. That's what I really like right now. buy physical silver. You don't have to worry about a tax from the bullion banks. You're always going to have your silver bars. They're never going to go to zero, and eventually the fundamentals will overcome it, and price is going to go up, and you're going to make a lot of money on your silver bars. But I like both at the moment. Well, I'm going to like both once we get our intermediate decline, and I temporarily like miners and SLV both for a bounce out of what I think is going to be the B wave bounce. But again, that may not last very long. It may only last 8 to 10 days, and then you may have to get out of the way again because we may have that C wave down. But at that next intermediate bottom, I like GDX or GDXJ, and I like SLV more so than gold or GLD. I generally don't trade gold itself in any form because the percentage moves are always going to be bigger in silver and miners.
And you're really talking about when you say that you're using these ETFs, you're talking about trading around them, not necessarily holding them long term as a sense of capital preservation, right?
Yeah. So to long-term hold, buy physical bars. Best advice I can give you for the next 5 to 10 years. I think you'll make an insane amount of money holding your physical silver bars. And also, the more people that buy silver, actual silver, the harder it's going to be for the cartel to manipulate it. If enough people buy it, you create shortages, and it makes it almost impossible to manipulate. So long-term, just buy physical silver. The ETFs are for trading. And so, we may have a trade setting up here pretty quick for a bounce. You could buy GDX or SLV for that bounce, but then you probably want to wait for that C wave down before you take a longer term position, something that you might be able to hold for 2 or 3 months.
Yeah, and that's an important distinction. You're really using two different tools there for totally different purposes, right?
Correct.
Perfect. So, Gary, can you give us a couple of resources that people could turn to really learn some more about this stuff and how to trade like this?
So I think it's fairly important for any trader to, that's serious. They need to monitor sentiment. I think everybody should probably get a subscription to sentimenttrader.com. I'll put a plug in there for Jason. It's a very good website that monitors sentiment, and not just in gold and silver, but in stocks, bonds, everything, energy, commodities. So that's important, and that's what drives cycles in the end anyway, is sentiment. But I also think it's not a bad idea to have at least a working knowledge of how cycles work, even though they can be erratic and they do evolve over time. What worked 10 years ago in cycles may not work anymore. I think a lot of that is just because there's a lot more government central bank interventions in markets now. Governments they want to keep stock markets propped up. They want to keep commodity markets suppressed if they can. And so the cycles evolve just like anything. And what worked, years ago, even 5 years ago, may not work now. But, you just evolve and you adapt to what the market gives you. But I think those things are pretty good resources for both people to have. You need to monitor sentiment, and you probably need to have a working knowledge of how cycles work.
Excellent, Gary. Is there anything else you'd like to add as we wrap up here?
No, I think we covered just about everything, Tom.
Excellent. Of course, your website is smartmoneytrackerpremium.com, and your Gary Savage one on Twitter, where you you post links to your free YouTube content that is posted at Gary Savage. You really put out some very interesting videos every couple of days to give people a taste of what's happening in the markets and how you're looking at them, right?
Correct. So yeah, if you want to kind of get an idea of what my analysis looks like, how I use cycles and sentiment, the blog, I think it's blog.smartmoneytracker.com, or you can just Google it and you'll find it. But like you said, I post free videos 2 or 3 times a week, and you can get a kind of an idea of what I'm talking about with cycles and sentiment. And then, if you want to get a little bit more into that and learn a little bit deeper, then I have the premium newsletter for subscribers where I go into a lot more depth in that those reports come out. Usually I do 2 or 3 reports a day.
Perfect. Excellent, Gary. Thanks so much for your time today.
Thanks for having me, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.